Thank you everyone for tuning into the webinar tonight. We've got about 25 minutes and I'm sure there'll be some Q&A, so I'll quickly go through the presentation that you can see and you will be distributed later. It's 17 pages, so I'll cover only a small number of those, and there's also some granular appendices for data on the business as well, which I'll let you read at your leisure. We've just released our preliminary results for the year ended September, hence the opportunity to speak to yourselves tonight. The story of the results really, and the things I'll be pulling out in this presentation and the themes coming from the annual results, is about operational resilience, both operating from home, as a lot of companies are, looking after our staff and their well-being, being operationally sound and looking after our customers as well. And our customers have required us for new lending in some cases, but also for payment issues that they may have, the so-called forbearance requests that are very common in the credit and finance industries. I'll also mention the markets we operate in. Important that you understand how they performed this year and how they look for the future. I'll talk through various aspects of the portfolio, profitability of the portfolio, of course, impairment, which is such an important thing for a credit lender and a bank, the growth of our portfolio, our tightening of our credit risk appetite, which we feel is prudent with the current economic outlook, and the aforementioned forbearance. There'll be some focus on that and the performance of our portfolio. And then finally, I'll talk through how we're ready to change gear when the UK economy changes gear and how we can take advantages in the future. We went into this pandemic with a strong balance sheet and good liquidity. We'll come out of the pandemic in the same way through careful capital management, and there will be opportunities abound. So if I could, someone else is controlling the presentation for me tonight, because I'm actually on an iPad. If we could move to the overview page. And for anyone that doesn't know us, we have 4 lending divisions: consumer motor, business asset finance, broadcast and media, that's a specialization, and property bridging finance. Just really, other than to say at this point, diversification into 4 asset classes has shown us strength this year, with some markets performing better than others. Our portfolio is 434 million, all asset backed, strong collateral value behind our full portfolio. It's funded mainly by retail deposits, but we also, as a lender to the UK private sector, SMEs and sole traders, we also get access to the Bank of England's term funding scheme, which is funding at 10 basis points, which is base rate. Our books continue to grow through the year, a focus on credit quality, as I've said. Our profitability is down, but that's through the IFRS 9 impairment charges. Our impairment charge has almost gone up 4-fold this year. IFRS 9 is trying to predict potential losses in your portfolio on a forward-looking basis, so those impairment charges haven't been realized as yet, but they are there sitting on the balance sheet should the economic scenarios that we've run and that are being forecast play out over the next 12 to 24 months. Our net interest margin has been compressed slightly. That's a conscious decision. If you go up the credit curve, you're going to have a lower net interest margin, and that will remain for a little while longer until we reassess our appetite for risk. Underlying return on equity, of course, down with the higher impairment charges. Cost to income ratio, however, we maintained at the same level because we did actually grow our book in the year. So we'll be slightly unique as a bank, because I don't think you'll see many banks growing their portfolio as strongly as we grew ours in the current year. Box 5 here, and really the story of the year, impairment in 2 ways for us. Credit impairment losses, potential, that is, expected perhaps, unrealized absolutely, but also impairment of goodwill as well. The Azul acquisition, you have to take an assessment of that at a point in time. I'll cover later why Azul has a great future and where we know it will recover, but at the point in time, September, we're looking at a business where its main areas of activity, which are film and TV, sporting events, live events, had all closed down almost overnight due to COVID. And also a portfolio that had the highest instance of forbearance initially as well. So it's understandable that when you do the calculation around goodwill, it needed to be impaired. Forbearance, we have a slide on that. That's all important later on. And I've already mentioned the strength of the balance sheet. If we move to the next slide quickly, operational resilience, the new business originations, although only flat, I'd say a very robust performance in a year where the second half of our trading was entirely covered by the lower demand through the COVID crisis. The portfolio has grown by 28% to 434 million, and our retail deposits are now 8,000 customers, 342 million. We've got a diversified funding model. We utilise the government schemes, and our funding cost has continued to fall from 2.1% to 1.7% in the year. Our loan book is now 79% prime customers. Historically, we've been both a prime and near prime lender. We feel the move towards prime has been going on for a few years since we've had access to cheaper funding, but it has been predominantly prime since March through the pandemic, with 85% of our originations this year being in the prime, having a prime profile. If we move on to financial highlights, adding back the goodwill, our profit before tax was 3.9 million. Of course, a fall when you're looking at impairment charges as high as that. But if you add back the parts of the impairment charge, which is roughly about 4 million to do with providing for future economic scenarios, you can see that we actually weren't far off last year. And when you consider how demand and the marketplace has actually contracted in the second half of the year, it's a pretty robust performance overall. Operating income increased, net interest margin I've already spoken about, and EPS and return on equity, of course, falling in line with profits. If we move to the next slide, which is on new business volumes, really just very quickly here, looking at the graph, the column right on the right-hand side here, you can see at the top of this slide, if Lisa can move on one slide, you can see at the top the change in emphasis into bridging property finance, which was a new diversification and very successful in the year, and at the bottom, the continued growth of consumer motor finance, and slightly squeezed in the middle, Azul, which I've already mentioned, having a poor year, and SME business lending as well, which I'll get onto, which has also seen a decrease in demand. If we move quickly to the next page, the new business volumes for the year, as I love to say, a game of two halves. So this shows quite clearly the COVID effect of new business originations in the year. Business finance steeply down, consumer finance continuing to be robust, Azul suffering from the reasons I've already mentioned, and bridging property continuing to grow. If we deal with consumer finance first of all, which is the next page, that growth was fueled by an objective, one of our prime objectives last year, which was to automate our prime proposition in the consumer finance market. And we launched that in March. Lisa, I don't know whether that screen can come up, consumer finance. And we launched that in January, and by March, of course, the COVID crisis was upon us, but that division has continued to operate strongly, and I've been quoted before that there's actually seems to be a structural change in the economy with a movement away from public transport, away to, into car transport. And of course, as a used car lender, we're extremely well placed to take advantage of that shift. We've also had some success in the leisure market as well, with staycations and the acquisition of motorhomes. Just a small niche area, but one that performed very strongly in the year. If we move to the next slide on business finance, for the reasons that you could probably understand, small businesses aren't really investing in business critical assets at the moment. Uncertainty leads to lower business investment. But on top of that, we've got the government support schemes, which are there to assist business in the form of CBILS and bounce back loans. And if you're a business that wants flexible cash flow, the government's working capital schemes around those two schemes are more attractive than our more traditional asset finance, which needs to be supported by an asset purchase. So a combination of those schemes and lower demand in the marketplace means that originations have fallen in that area. That will recover. Businesses can't continue to not invest in assets. It'll just be about timing. Azul, I've already mentioned, a niche market, affected almost overnight by COVID crisis, but we are starting to see some good signs of life in that area, and those signs of life have started with the on-demand streaming services, where parties such as Amazon, Disney Plus, and Netflix are all huge investors in the UK market. Disney Plus, for example, taking a 10-year contract on Pinewood Studios, and Netflix similarly 3 years on Shepperton. We're uniquely placed to take advantage of that investment in the UK and in new broadcast and filming equipment, and we've seen a number of large deals in that space just starting to reoccur over the last month or two. They should get us through winter until we see a return to the more traditional live events, sporting events, TV, documentaries, soap operas, and the such, which is the lifeblood of the TV and film industry, but typically takes place in the longer daylight hours and summer months, starting from spring. And lastly, property bridging finance, where we provide bridging for residential residential refurbishment projects, first charge mortgages, low LTVs, and an average LTV across our portfolio of only 60%. We saw a number of people withdraw from this market temporarily due to liquidity concerns, non-bank competitors, I would add, and we've been able to step in there and take, in some cases, their position on very strong and good quality transactions, but also retain those relationships which we've been able to build while other parties have been out of the market. If we move on to a couple of pages on to the forbearance screen, which is 13, and another one, please, Lisa. You can see how forbearance, the first requests of forbearance, appeared in Azul and Coach and Bus, which was heavily hit in February and early March. At its peak, 140 million of our portfolio had asked for some form of assistance. And as we sit today, that is down to 23 million. And you can see by the graphical depiction there how that's come off very steeply. Motor finance has the lowest level of forbearance. Business finance and Azul still have the highest, but much down on their peaks. And what we found was a lot of customers, it was heavily advertised, heavily spoken about by the regulator. A lot of people, and quite rightly, were very cautious about what this pandemic meant and asked for assistance. And what we found after their first request for assistance is they realized they didn't need it, and it was a precautionary measure, and it started to fall away. If we move on to the next slide, onto the achievements for 2020, yes, there were some, even though the second half was really just about navigating the pandemic. We launched our new motor proposition, hugely successful, great proof of concept in the first quarter. That's there really to deliver higher volumes as and when, one, demand picks up again more strongly than it is at the moment, but also two, when we broaden our risk appetite away from just the tightest of prime credits in that market. And that's something that's under review all the time. And I'm sure we'll do as the UK economy shows signs of improvement. We've diversified our balance sheet and our asset classes through property bridging finance, which has been a success. We've shown operational resilience right across the business. We've monitored capital and liquidity very closely to leave us in a very strong balance sheet position. And all the while, we've been continuing to invest in our platform and our people to make sure that we are in a position to take advantage of growth in the future. If we move on to the next page, which is the future operating model, we've used this time of lower business activity to launch an operational review, refine our processes, streamline our straight-through processing, digitalize a number of our processes, and actually look for greater efficiency so that we can scale the business as and when we want to actually increase originations again. We'll also launch a SME portal, very similar to what we launched in the consumer motor area. We'll launch that in calendar Q1 this year, learning much from the development of the consumer side of the business last year. The next page, which is investment case, all of those things held true. We hold a great deal of contracted income on our balance sheet. Lisa, that's the next page, if you would. The 69 million, which gives us certainty of income going forward. We've got a management team who have been in these markets for a lot of years. We've managed portfolios and businesses through all aspects of the credit cycle. We have competitive advantage through a banking license, and we've got a robust business model with a small market share, diversified income streams, good balance sheet strength, access to the retail deposit market, and continuing to invest and enhance our infrastructure. Banks, and small banks in particular, have had a pretty tough time of it if you look at it as a sector. And I think you've seen some rally more recently in the banking sector, and I think that's because people realise the worst of the impairment issues are behind us, and that the bank's going to play a very important part in the recovery of the UK economy. And finally, if I finish on page 17, the last page is on outlook. You've heard that we're well positioned post-pandemic. The loan book is becoming predominantly prime. I think that's the right positioning of the business in uncertain times, and we're very pleased that we've been on that journey for a number of years. We expect the impairment charge to reduce next year. We expect the income embedded in the book to deliver certainty of earnings. We'll have a target of 750 million of portfolio. That's been put back slightly by the pandemic, but we would hope to get there by 2023. We'll keep our risk appetite under review and move back into the tightest prime markets at the most appropriate time. Until we do, NIM will be a little bit under pressure. But we will release, as certainty becomes into the marketplace, some guidance around our performance. Portfolio growth and originations are, of course, key to us, and that's a little hard to judge at the moment. And also impairment charge, although we expect it to fall, we just need to see how quickly the UK works itself into a better position. So I think as and when that's ready, we'll be ready to take opportunities. We'll be ready to look at market consolidation. We'll be looking at M&A, further diversification, and portfolio acquisitions. All of those things will become available to us. And finally, just on dividend, we have deferred the decision on a dividend, but we did actually pay a dividend through in the course of this year in April, unlike most financial services businesses. So it's not as though we're avoiding it for the year. It was just paid earlier in the year when most banks were precluded from paying a dividend. So with that, I think I'll hand over for any questions on the business.
The questions might jump around a bit from subject to subject, so please do bear with me. First one, how has it been possible to achieve good growth in motor finance when motor sales have declined? Is it at the expense of margins?
No, it's not, and I perhaps didn't play enough on the fact that we're not a new car finance company. We avoid that. We avoid that because we don't have to take on the manufacturer-owned finance companies. So we're used vehicles, and the boom in driving cars and moving away from public transport has all been in that used space. If people require a second car, it has been the purchase of a second car. And if you look deeper into Marshall's or Vertu or Looker's accounts, you'll see that the real any success that they've had in the current trading period has all been in the used car market.
And so how are the loans distributed? Is it via those sorts of names you mentioned?
Broker intermediaries. So both our SME finance and our motor finance side are through broker intermediaries. The Azul side is direct with the manufacturers and distributors of broadcast equipment.
Okay, next question. During a 2019 presentation, you indicated AI was being deployed. How is that progressing?
It's progressing in the SME portal, and we're increasingly using it to help make decisions around credit decisioning for SME, which is a little bit trickier than consumer. As I said, the plan is to launch that on a test basis in the first quarter. So we're not that far away from seeing how successful that is.
Okay, question about government and the lending schemes. Government put out CBILS and the other one, is it BBILS, business?
Yep.
Was it an option for you to be involved in either of those, to be involved in those loans? And if so, why did you choose not to take it up?
Yeah, because we'd had experience in the previous government schemes, which were the financial guarantee scheme, which was singularly unpopular with both borrowers and banks alike for the administrative burden involved. So our experience there told us that we're probably best supporting our markets by actually continuing to lend, which we continued to do right through the pandemic across all 4 business lines. And we thought that is the best way to support the companies that we deal with. Our experience of getting involved in the government schemes is demand is extremely high, ability to process the applications very difficult, and satisfaction levels fairly poor. And if you add to that the fact that the BBILS product was at very low yields, it didn't meet our profit hurdles as well. So all in all, we thought it better to focus on the business we know, the business we're good at, dealing with the customers we've always supported. And even with that, we managed 28% portfolio growth.
Question about moving to prime. I was trying to try and understand this. You think moving to prime lending would put you in a more competitive place, but from what you described, people are moving away from that market. Is that right? Have we understood that correctly?
It is. The statement is true. It is a more competitive space. It's the largest part of the market, and we've only got a very small market share, so we don't find it that difficult to actually win business in that space. But certainly as we become a bigger player, that will become more difficult. But what we will do is we'll change our focus to being not solely prime. As I said, we've got a history in the near prime market. We're very good at it. It carries a little bit more risk, but it carries quite a bit more yield. And at the appropriate time, we'll enter that market, and that will complement our entry into the prime market.
Okay, so just a quickie here. Someone's asked a couple of times, are there any particular regions that you do more work in, of the UK, that is?
We're entirely England, Wales and Scotland. And I would imagine the spread is pretty even with the population spread. But Certainly some of our SME customers who deal in haulage, coach and bus, machinery engineering have quite a high level of incidents in the Midlands and the middle of the country.
Okay, and the final one I've got here, and we have time for, is about market share. You've mentioned you've got a relatively modest market share. Are you able to express that as a percentage? And then when you
I certainly can. Yeah, if we consumer motor, we have about 0.6 of the market. That's a 92 million per annum market. Just looking at used car intermediary brokered business, we have 0.3% of the SME market. Of course, we wrote a lot less of that business this year. I think we had about 0.5% the year before. Azul is a niche. We have about 45% of that market, so we're a very big player in that space. And property, we have about a 1.5% market share. So all of those are quite modest.
Scott, thank you very much indeed for presenting and joining us this evening.